If we're moving, yeah, I think now we're all good. Yes, we have the audio, we have the video going. So welcome to Traders Lessons, another training session today for all of our friends all over the world that are ready to trade, ready to invest into the market. Today we're going to talk about the basic terms in trading, another topic that we do believe that it's very important uh, for everybody to learn more of how to work on the trading field by knowing the basic terms, by knowing more about the very simple things that can actually help you be more successful into the market. So basic terms in trading will be the topic for our webinar today. We're going live into our website, traderslessons.com. We're going live into our Facebook page presently. Later on, this presentation will be uploaded on our website. Actually, I want to say that there will be packages with this presentation along with many other topics. You can take only the information from the presentation, like the basic terms and everything written down, or you can actually have it along with the recording of this webinar session. We have one already for basics of trading. Today we're going to talk about basic terms in trading and so on and so forth, moving from the basics of each and every part of the investment world into most importantly the more deep investment side of the markets, deeper look into the market, deeper look into the charts, into the technical, the fundamental analysis, so on and so forth. So many topics, so many things we can cover, but we're going to start today from the basics. Just like last time we got the basics of trading, like which is which, the basic terms in trading. Today we're going to talk a little bit further. We're going to take our session to the next level, if I may say. So what are the topics for today? What are we going to do today? First, we will be talking about understanding the spread in the forex trading. What is spread? We discussed it in our previous session. Today we're going to get a little bit more deeper into it. We are trying to have, let's say, following up on what what we're discussing so far. So we're going to do further with this, understanding the spread in forex trading. Then we're going to talk about what are pips and how they are used in forex trading. Then we're going to go to the explaining the concept of lot in forex trading. Again, lot or position size is something we discussed in our previous webinar, in our previous presentations, but still it's something that I believe it's important for everybody that is investing in any kind of field, either it's trading with leverage or without investing in any kind of financial instruments. Then you're going to go to understanding in the equity of your portfolio and its importance to trading. Then we're going to talk about the difference between the balance and the equity. Many times people tend to feel it's the same, but it's not on 100% covering each other. There are different things you'll be able to see in a moment. Then we're going to talk about managing your exposure and risk in the trading by opening different positions, again something related to the lots, and of course managing exposure and risk into forex trading positions. This is something that we are going to talk about further. Now, the first one is understanding the spread in forex trading. Um, First is the main rule, the main definition. We're gonna put it this way, and we're gonna continue further. I'll try to explain a little bit more afterwards. So, definition and significance of the spread. Spread refers to the difference between the bid and the ask prices. It is a key factor in determining trading costs and potential profits. Also, factors influencing the spread: market volatility, liquidity, and the broker's pricing model impact in the which is basically impacting the width of the spread, affecting the trading conditions on every single trading portfolio, and impact of spread on trading decisions. Understanding the spread helps the traders to assess the cost of entering and exiting positions on the market, and it's influencing their trading execution and strategies. These are the three main definitions, three main topics that I'm going to talk about right now. Very simple. I'll try to explain. The first one is the difference between the bid and ask, the buy and the sell price. This is how you can monitor and you can actually detect any spread. Many companies tend to market their spread is zero. They tend to market that they have volatile or fixed spread or whatever. No matter what they try to market to you as a trading company, everybody has their own approach to it. So if you like to know exactly for a specific product, stock, index, commodity, whatever, currency pair, you want to go exotic, you want to go local, doesn't matter really. No matter what you are trading with, you can check the spread for it, the difference between the buying and the selling price. Even if something is stating on the website of the company you're working with, if it's stating zero spread on a product, before opening the trade, please double check if there is any difference between the buy and the sell price, so you know surely that whatever it's marketed on the company's website or on the company's platform is actually true. After you do that, then you can start with the calculation of how much you should open from this specific product. So first check what is the current difference between buy and sell, so you can know if the spread is real or not. And from then on, talk about market volatility and liquidity, meaning if you are working with a product that is extremely volatile, well, in this situation you need to know that companies might extend the spread on specific products for a specific period of time. You need to be aware that the spread terms and conditions are usually fluctuating, they're changing, exactly because companies are trying to protect themselves and clients from market volatility. So this can, as I said here, it can impact, it can influence the size of the spread, and how you can actually calculate your risk in trading and the amounts that you're trading with. You do that by making a simple calculation. Let's say now you want to open one position on gold. It's very popular recently. It's been skyrocketing for the past 2 weeks. So you want to open a position on gold. You want to open 10 ounces of gold. And you double check. Let's say the difference between the buy and the sell price for the gold is 20 cents. Meaning that for these 10 ounces, you're gonna be starting on a minus of $2. How did I get there? Very easy. 10 times 0.2, and this is $2 difference between the bind $2 minus for you in the spread, because the difference between the two prices is 20 cents. If it's a dollar, it's even easier. If the buy, let's say, is $1 higher than the sell price, this means that the spread is $1. And in this case, you calculate for 10 ounces, I was starting on minus $10. And after you know this calculation, after you've done this calculation, you can easily do what? You can see what you have as capital in your account, and you decide, okay, I have $1,000, $10 minus will not affect me, or $2 minus will not affect me. Or you're gonna say I have only $50 in my account, so $10 it's like huge portion, huge chunk of my account. But if the spread is $2, you say, okay, $50, I'm taking only two out of the spread, fair enough, I can go with it. So this is how calculating the spread prior opening of the position can help you place yourself into the market better. We continue further with analyzing the role of spread in forex trading. Spread's influence on trading profitability. A wider spread can diminish potential profits, making it essential for traders to consider spread size in risk management. Something that I've just explained. If the spread is too high and you're not expecting that big of a movement on the product that you're trading with, in this case, you should consider whether you should enter into this trade or not. Relationship between spread and currency pairs. Different currency pairs exhibit they actually show they exhibit different spread sizes. Usually, exotic currency pairs have bigger spread size than the regular ones. Like the most common ones are euro dollar, pound dollar, dollar yen. Usually they have less spread because many people are trading. There is big liquidity, something I mentioned in the previous slide. They have big liquidity, so the spreads there are smaller. Many people trade with it. But the exotic ones are usually charged on bigger spread with any brokerage. So something that can be important when you are starting your trading, or even while you are trading already, you can make comparison across brokers, like which company offers what spread for this or that product. So in this case, you can spread even your investment with different brokers depending on the spread sizes on an investment. It's very interesting actually that yes, There is this basic standard for have basic currency pairs, exotic currency pairs, and to give different spread on them. But sometimes there can be a surprise in the charges, so you can check that if you like. We continue further with maximizing trading efficiency through the spread awareness. Something I just said. Here you see it pretty. Here you see it in our presentation, but it goes like that. Utilizing the spread data for informed decision making is essential because accessing real-time spread information empowers you as a trader to make precise and strategic trading decision, optimizing your profitability. As I said, to see exactly on which product to enter, with what kind of an amount, so you know, let's say you're expecting this or that movement on the market, and if this movement will be actually enough for you to cover the spread or not, to actually be on real profit, some reasonable profit. Okay. Informed decision making is something is extremely important when it goes to spread and investment in general. What now? Next thing that we're going to talk, because if you want to utilize the spread on currency pairs, for example, on forex trading, the spread is usually evaluated in pips. Now we're going to talk about what is pip, and then we'll see how we can calculate it. Okay, pips in forex trading. Definition of pip. Pips are the smallest price movements in forex trading, representing the change in value between two currencies. Currency pair, let's say euro against the dollar, it has a price. It has a fixed price, and the spread is making the difference between the buy and the sell. This difference between the buying and the selling price is usually, as I said already, calculated in pips. So this last particle, usually the fourth digit after the dot, and for some like dollar yen or euro dollar, for example, the second digit after the dot, this is the pip. And this is where the spread usually occurs, in this last digit after the dot, the fourth or the second, depending on the currency pair. So pips are typically calculated to the fourth decimal place for most currency pairs, except the Japanese yens, which are on the second, something that I've just mentioned. And the main idea of being calculated in pips means that, first of all, none of the companies that out there would like you to pay too huge amounts on difference between buy and sell. This is why they're not extending their spread lines so vast. They're mostly focused on small changes, the pip changes. So whenever you're making a calculation, you need to see the last digit after the dot. If two digits after the dot are different, this means very simple. I'll tell you, it means that for this particular currency pair, the spread is pretty high. Like if it's influencing more than the last one, let's say the last two, this means already that you're working on a product with a very big spread. Okay, using pips in forex trading. Risk and reward. Traders use pips to assess potential risks and rewards in their trades, helping them make informed decisions and manage their trading strategies. Meaning, if you now go and open a position for a product with 10 pips of difference between the buy and the sell, 10 pips spread, you know that you should expect at least 20-30 pips movement on your direction, up or down, depending what you took, before you start generating some real profit, some reasonable profit. Everything to the 10th pip is covering only the spread. So setting price targets is something that you should do, exactly from what I'm saying. Pips 8, setting prices targets, and it will allow you to determine the level at which you want to enter or exit a trade. In this case, you'll be able to decide how to limit your potential profits or losses. At a situation where you see 10 or 20 pips difference between the buy and the sell price, and you want to invest into this product, currency pair, I mean, you should check the chart, make a decision. Okay, I see this one is going up. I see the potential is like 40 to 50 pips movement for the day or for the week or whatever. I'll be charged 10 out of this 30, 40. Still, I'll have something for me as a trader as profit. So I know I would like to exit when it's reaching 50, or and I'm gaining these 50 pips, or exactly the opposite. If am losing more than 50 pips out of it, obviously it's not going my direction. I better leave it. So using and understanding the market volatility will be essential for you to focus on predicting what kind of movement you expect, what kind of impact you expect in the market, so you know whether to enter into this particular trading product following the pips movement. Now we're going to explain the concept of lot into forex trading, or position size, you might call it. Definition in lot in forex trading. The lot refers actually to the standardized quantity of financial instruments that is traded. Different platforms, they have different lot sizes or different quantity sizes, if you like, and this is exactly why you should, when you start trading with a company, no matter which one, you should double check and see the position sizes. Either it's evaluated in lots or it's evaluated into amount. One is amount, the other one is lot size. One lot, 0.1 lot, and so on and so forth. Or in amount, let's say 100,000, 10,000, 1,000, and so on as amount entering into the market. Now remember, the lot size and the amount size of a position is always with the leverage that you're working with on the company. So if you see 1,000, it doesn't mean that you need to enter 1,000 from your capital. Usually this is 1,000 from the amount that you invested multiplied by the leverage you're working with. Okay, another thing that you can do working with the lot sizes, working with the amount, the weight of the trade that you're going to open, you can actually influence your profit like this. I told you already with the pips. Let's say we expect 50 pips movement. Now this 50 pips we need to multiply it by the lot size, by the amount we are entering with. So if let's say you're targeting $50, you need to choose a lot size, an amount that can target this $50 profit with these 50 pips. Otherwise, you will be facing a contradiction. Let's say you want to go with the smallest lot size, entering and expecting the highest profitability. This involves risk in which you might never reach this level. Your take profit level, it might never reach, and you can be ending on the losing side. Next one we have is examining the role of lot in forex trading. I already explained a little bit more about it, but now we're going to go through it in terms of definitions. Properly choosing the lot size is crucial in managing the risk and determining the appropriate position size for a trader. I already said that whenever you're entering and you're expecting, let's say, 50 or 5,000 or $50,000 profit, you better know what kind of lot size you're using, what kind of amount you're using in the market. Because if it's too small and waiting too big of a return, you can end up surprised that it's not working out. In the other hand, the lot size directly affects the leverage and margin required for a trade, meaning that not only that you need to target a specific amount for a specific profit, but you need to know whether this will influence too much your overall risk, your overall exposure into the market. So you don't go all in, if I have to put it this way. If this lot size is something that obviously your account is allowed to support, but it will be exhausting almost all of your capital, in this case, again, you might end up surprised that it didn't work out that well. So you need to make these two calculations. First, your expectations, how much you want to get from this trade, and is the lot size enough to reach this profit according to the movement you're expecting. And second, if this lot size that you open and will match the profit, the desired profit, will it be okay to support in your account, or it will be too heavy for the account to support? These are two things you need to learn and you need to calculate before you enter. Understanding equity and its importance in forex trading. Now, as I said, basic terms of forex trading equity. Equity represents the current value of trader's account, including profits and losses. It reflects the real-time financial standing and impacts trading conditions. Meaning, if your equity is too high, you can go and trade more. If your equity is too low, you should wait or try to maximize your trading. So both ways, it will impact your trading decisions and trading conditions. You should regularly evaluate your equity level. In this case, you'll be able to know whether you are risking too much, and you need to adjust, in this case, the position sizes that you're opening. On the other hand, if your equity has grown a lot lately, in this case, you can again adjust your position sizes, your trade sizes, to match your new account level, your new account state. Let's put it this way. If your new account status is higher, you can easily go for bigger trades. If you're getting lower, okay, you need to reduce your trades a little bit. So maintaining equity for sustainable trading is important because it is preserving, and you need to preserve your growing equity through discipline in trading, practice it, and know market movements. Meaning, your equity now is getting too big, but right now your lot sizes are getting too big as well. So you need to be disciplined, and you don't need to go all in once you see something is working for you for a while. Still, there is risk for you to end up on the losing side, regardless that you were under the impression that your equity was growing bigger by opening only big trades. Difference between balance and equity in forex trading, again, something essential. Now, understanding the concept of balance in forex trading. Balance refers to the total amount of money in a trader's account, including the profits and losses from closed trades, along with any other trading benefits you might have received from your broker. And in the balance basically represents the total financial status of the account. The total, like everything, profits, losses, benefits, bonuses, whatever, it's in the balance. The equity, on the other hand, represents the real-time value of trader's account, considering the opened positions and the unrealized profits or losses. It reflects the current value of the account. Now you see your balance, you see total how much you have so far, what you've gained or what you've lost so far. The total is in the balance. But in the meanwhile, if you have trades running, you'll be able to see your current status of the account with the equity. Because many times, let's say, your balance is $100,000, but your equity is $10,000. Obviously, most of these 100,000 are right now in the market. They're getting exhausted from the market, so there's some action that needs to be done. On the other hand, your balance is $50,000, but your equity is 100,000. So you are gaining around 50,000 more in your account. And this is the time for you to make a decision. All right, I should close and utilize some of this profit that I'm making, or no, I should wait furthermore. Again, up to you as a trader to decide what to do. Managing exposure and risk in forex trading. Now, when it goes to exposure, I told you already a couple of times, the position size, the lot size, this is the exposure, the amount you're entering in the market with along with the leverage. Exposure refers to the potential impact of market movements on a trader's open positions. It's showing both the financial and the psychological aspects of the risk, meaning you know you're opening a very big trade, which means that it can potentially bring you a lot of money. But on the other side, it will also expose you on a lot bigger risk, because if you open too big of a trade, this means that the account is getting pressured, overweighted with this particular position, and you are, as I said already a couple of times, you're entering all in with it. Assessing the risk through exposure analysis. Evaluating exposure helps traders identify potential vulnerabilities and adjust their risk management strategies to maintain a balanced and sustainable approach to trading. Meaning, if right now you see a balance of $50,000, let's say, and you have a position that can bring or lose 50,000 in less than an hour or less than a minute even, this means that obviously right now you need first to assess your risk and to adjust your exposure, maybe to keep it if you're willing to risk it, or close it and lower it a little bit as an amount, as a lot size, so you know you have enough backup capital to hold the position long enough until it goes in your direction. Managing exposure through diversification is another thing that you can do. Many times you'll be able to see how you can trade different products, currency pairs, commodities, indices, and stocks in the same portfolio. If this is your case, you can manage your exposure, you can manage the weight on your account by using diversification, covering couple of markets, couple of products. In this case, even if one of them is not bringing you money right now, the other ones can move in your direction and actually compensate for the ones losing. So yes, managing your exposure is something that you can do by diversifying your portfolio with different types of products. Assessing the risk of the exposure is, as I told you, very, very crucial, because even if you diversify, some people tend to be confused, meaning they think that I have currency, commodity, and stock. It doesn't matter how big they are. I am diversified. This is true, you are diversified, but it's not true that you are secured. Exactly the opposite. You need to manage the exposure, you need to assess the risk with your exposure, because if all of these trades are like using the maximum possible from the account to support them, each and every one of them, even the smallest impact on the market can actually wipe you out, regardless that you do have three different types of products in the market. So you need to first determine the appropriate position size, because it's crucial for risk management, and it involves considering factors such as account size, your balance, risk tolerance, like how much you're willing to risk, and market conditions. Will this be a highly volatile market today, or exactly the opposite? It will be calm trading day, or week, or month, whatever. Also, implement risk mitigation strategies. Traders can use various techniques such as stop loss, take profits, hedging, and diversification to mitigate potential losses and, of course, manage their exposure to the market fluctuations. These two things, along with the conditions of monitoring your exposure levels all the time, can actually help you build better trading strategy, build more profitable trading strategy. Even only by diversifying, you can still be on the successful side, but using the diversification with the calculation of your exposure and the potential market movements can even put you to the next level. You can build you up to the next level. Trading psychology is something that also would like to talk about. Like, everybody wants to do maximizing profit potential and minimizing losses. Like, I want to make the maximum out of the minimum effort and the minimum loss that I can take. It sounds great. Indeed, it sounds beautiful in theory. In fact, your psychology needs to be on to how to calculate the whole picture, the balance, the exposure, the pip change, the market change. You need to calculate all of this and stay calm, especially if things are not going well in your direction. So, first thing you need to assess, regardless that, let's say, you are diversified, is the leverage and its impact to your exposure. If your leverage allows to trade with a way bigger capital, you need to know that big trades not all the time means only big profit. Sometimes it means bigger risk. So your trading psychology needs to stop there. Your mind should stop there and think, all right, I can do even 10 lots, or let's say a million out of this on a position. But will it be wise? Will I have enough capital to support such trade? I know sometimes people tend to be more overexcited, but this is part of the trading psychology that you need to consider. Bigger leverage and impact in your exposure can be either beneficial or it will be crucial for your loss. Setting profit targets and risk reward ratio, establishing clear profit targets and maintaining a favorable risk reward ratio is also essential to maximize your profits. Why? Because I should not go and simply open the maximum trade possible saying I want to make the maximum out of it. I don't know where it will get. The more it gets, the better. No, you make your own analysis, something that we're going to discuss in our further sessions. You make your own analysis and you see exactly how much the price can go, and exactly the opposite, how much the price should go against you before you know already that it's not your direction. Adapting and changing market conditions. Traders need to adapt their strategies and risk management approaches to accommodate shifting market conditions and maintain balance and exposure on higher level. What do I mean? I mean that when you adapt, I mentioned it already, but you adapt it like that. Right now, you know there is a week with a lot of volatility expected on the market. Further in our sessions, we'll know how we'll be able to see that. And in this case, you adapt your trading strategy by using smaller lot sizes, smaller positions, expecting some good profits, yes, but not being too much in risk. On the other hand, you have slow market conditions. You have a very calm week coming. In this case, you can increase your lot sizes. You can increase your risk reward ratio because you know the market will be slowly moving and there is time for you to react. And the movement cannot be so big to put you into big risk. In this case, again, you adapt your trading strategy into the current market situation. And of course, learning from trading experience. Whenever something happens and it's not working your way, you simply learn from it and you continue. Otherwise, you only get frustrated. You start chasing the market. It's never a good idea. Psychology and discipline. I'm pretty sure you can see this slide. It's very important. And for everybody, I'm pretty sure it will be essential when it comes to starting or even long-term trading, because you need to emotionally discipline yourself and not to be panicked or not to be overexcited whenever you're making profits or losses. You need to make trading discipline, like you do have products that you know how they work, you search for new opportunities, but you don't go in something you really have no idea about just because somebody told you about it. Psychology resilience in facing losses. Developing psychological resilience is important for managing exposure and risk and managing trading. Because, as I said, if only you know that if you enter and you say, I only make money, and on the first loss, you say, this is not for me, what should I do, and so on and so forth, it's causing panic. You start closing minuses, you start closing losing, and then you'll never see the end of it. So also, you need to understand that not every single trade that you open will be profitable one. Just you need to learn how to deal with that and calculate your risk reward ratio so you can overcome your losses with your profits. And continuously learning and improving. Every single day you can learn a new thing. Every single day you can find a new trading opportunity. And you can do this either with the help of a professional from the company that you're working with or on your own or with our help with Traders Lessons. As I said, we have many videos on our YouTube channel. We have a lot of information on our Facebook and on our website. We have our courses there written for everybody and actually available for everybody to watch and use anytime they want. So for the end of our presentation, I would like to thank you all being part of Traders Lessons webinar and willing to learn more and develop your knowledge. As I said, this presentation will be available on our website along with the recording of this training session. We will do more training sessions with more topics. We will also make rotation and start all over again from the beginning, just to cover it all one more time for everybody. And I really want to thank you for being part of our community. I really want to encourage you, take advantage of our training packages, take advantage of our trainers. Me and my colleagues are here to help. We want to provide profitable and exciting trading experience for everybody that wants to trade in the financial world, because this is a very fast developing market, and we do believe that our experience can help everybody learn and earn in a better way. Thank you all, and I hope to see you in our next training session. Goodbye.